I buy a property, then I borrow on the property and I buy something else. So with my base, what I can do is I can borrow, lend, borrow, like that. And that is what interlocks the balance sheets of all financial institutions. So Bear Stearns would be interrelated to Goldman Sachs, and Goldman Sachs would be related to Citibank, and Citibank would be related to something else, and therefore there's interlocking of the balance sheets, okay, through this process of borrowing and lending. So what happens is that there's a gearing. This is called the gearing ratio. This gearing ratio, in the case of Bear Stearns, when it failed, was 33. In some cases it is 40, in some cases it is 50, okay. Now, what is the problem with this? The problem with this is, on 100 rupee of my own asset, I have borrowed 3200, okay, because my gearing ratio is 32, and therefore I have liabilities of 3200 and assets of 3300, okay. Now, if I have assets of 3300 and I have liabilities of 3200, and if these assets fall by even 3%, then I have taken a loss of 100 rupees on 3300, and my own capital of 100 rupees has got wiped out. So a very small amount of fall in the asset value results in my collapse, okay, and that is what has happened to most of the financial entities that you have, where the collapse has set in, because they were borrowing and lending. So balance sheet has these two sides, and on the side of the liabilities remain, assets collapse, okay, because liabilities don't collapse, okay. If I owe somebody something, I have to pay that. Okay, so that side is not going to collapse, it is this. So every entity in this kind of market has a gaping hole. So the question is, why am I doing it? Because if it's so risky, why am I taking this kind of risk? Because I get high returns. Suppose you take, I borrowed 3200 rupees and I have, assets of 3300. So on the assets of 3300, suppose I'm even getting 5% return. Okay, so that amounts to about 165 rupees. My own capital is 100 rupees. After paying the return on that, say, of 100 rupees, I still got 65. So I've got a 65% return on it. So by this high gearing ratio, I get a high return. I get a return which is multiple of what I can get on my own asset if I don't borrow and lend. So therefore, this gearing is done so that I can get a high return. Now, when I get a high return, my shareholders are happy. Okay, they say this activity is very good. The people who are lending to me, they are happy. Okay, and the people who are working for these banks, they are happy because they are getting hundreds of millions of dollars of bonuses. Okay, so everybody is happy. So as long as this chain continues, as long as I'm borrowing and lending, okay, I can make capital gains, and that capital gains helps everybody, and everybody is very happy. Okay, but here is the catch. And what is the catch? Suppose the price stops rising for any reason, then my return collapses to zero. So from a high return, I go to a zero return, and immediately it becomes unprofitable. So I start selling. The moment I start selling, then what happens? It starts collapsing. So in other words, the rise is gradual like that, but the collapse is sudden. Okay? And when the collapse begins, then everybody has gaping holes. Okay? And this collapse only requires even a marginal fall in the return, in the capital gain. And if you look at the data from the US economy, from 2006 onward, capital gains in the US economy started falling. Okay? So fall of capital gains means returns have to start declining. And when returns start declining, then the reverse cycle. So you have a build up taking place like that, and then when the reversal takes place, then it's a sharp reversal. Okay? And that's why what you find is that the collapse in the financial markets was very, and that's why large number of entities have suddenly got huge gaping holes in their balance sheets. And whichever entity you take has holes in the balance sheet. Okay? And that's why today nobody trusts anybody else. Because suppose I lend money to you, okay, and you have a gaping hole, then my money is not going to come back. And anyway, I have a gaping hole in my balance sheet. So whatever money I can get, I'm trying to cover my own gaping hole. So therefore, as if you look at the New York Times of the last 2 months, it says credit has frozen. Credit is not moving. Okay? In India also, the government, as you know, the Reserve Bank has released 2,70,000 crores of liquidity in the last 2 months by the various actions of CRR and various other actions. Okay? But 2,70,000 crores, still everybody is complaining that funds are not available. Producers are complaining funds are not available. Exporters are complaining funds are not available because people who are exporting, their letters of credit are not being given. Okay, so how do you export without letters of credit, etc.? So suddenly activity has declined, and declined at every level. Okay, so this kind of a very, what I've called in this model, I'm going to skip all this model that I have. Okay, okay. This model which I'm skipping is basically telling you that this is asymmetric, that it rises gradually but it collapses very suddenly, and that is why markets are not self-correcting. This idea that markets are self-correcting is not right, because they don't revert back to the stable position, they just collapse. Okay, so that's an important thing. The second thing is the collapse is very sudden. So this model actually shows these things, but I'll skip that. Now, when I'm creating this asset on my 100 rupee of base, I'm creating this 3200 rupee worth of other assets by borrowing, then my own asset base has to be stable. If that is not stable and that starts falling, then my overall structure starts collapsing. Okay? Now, there are many features because of which this own asset base will rise, but there are even larger number of reasons why this asset base will collapse. So I've given these 2, 3, 4 reasons why the asset base would rise, but then the more important thing is why the financial base starts eroding. Because that is what led to the subprime problem, and that is what led to the eventual fall. In that, I'll only mention a few things. One of them is that the US economy's savings rate has suddenly plummeted. From 2000 onward, now the US economy's saving rate is roughly around 1%. Okay, and in 2005 there's one quarter where it was negative savings. Therefore, the US economy is living on borrowed capital. Its capital is coming from outside. Its capital is coming from China, from Japan, from Europe, from India, etc. Okay, we are keeping the US economy afloat in that sense. The implication of that is that the US economy, okay, 60% of the government securities are owned by foreigners. 30% of the corporate equity is owned by foreigners. So therefore, whatever profit you generate in the US economy is going out. And when that is going out, the asset base of the US economy is shrinking. And that actually creates a problem. That's the first problem. What is the second problem? The defense budget of the US economy started rising from 2000. Internal security budget of the US government has started rising dramatically after the 9/11 problem. Okay, that has shaved off about 2 to 2.5% of GDP of the US economy from what was available for creating the asset base. So that's the second reason. What's the third reason? Huge number of tax havens have been created in the last 20 years. Okay, at the current count, there are 77 tax havens that exist in the world. Okay, what are these tax havens? You take your profits out and pay no taxes on it. And this money that you take out is footloose. So it can very quickly go in and very quickly come out. Okay, so the problem of the tax havens is that this money that was going into the US economy, because after all, tax havens have to invest somewhere. So part of that money was going back. But the instability was getting created because more and more money was going to the tax havens and more of it became footloose. Now, compounding this was the problem that the US economy was living on borrowed funds. So trillions of dollars of US economy's funds were actually lying outside, the dollars, okay? And therefore people were losing faith in the dollar. And therefore the dollar started declining and the euro started rising, okay? The yen started rising. Now, this is a very important thing for the world economy, because until about 2002, 2003, there was a dollarization of the world economy. People would hold dollars. Suppose you went abroad, you took, say, $1,000, you came back, you had $500 left, you kept it in the house saying, next time when I go, I'll use it. Some people had $10,000, somebody had $500, etc. This was all an interest-free loan to the US economy, the seniorage associated with